Hello, class. All right, we're going to continue with the second two types of adjusting entries. So the first one is unearned revenue or deferred revenue. And we call it deferred revenue because we receive the cash now, but we've put off recognizing the revenue because we haven't earned it yet. So we talked about this last week. An example of unearned revenue is like when my company manufactured cushions for a five-star resort. Hilton would pay us a $20,000 deposit, but that's not revenue. I haven't earned it yet. I will earn it when we make the cushions. So when I put that money in the bank, I'm going to record cash, but then I'm going to record a liability unearned revenue. And it's a liability because I owe the customer something, either the cushions, which is what they really want, or their money back, but it's a liability for the company. So then the adjusting entries are going to be used to decrease the liability and record the revenue when we earn it. That's the adjusting entry, to decrease the liability and to record the revenue. So let's say that Fast Forward's client paid a 60-day fee in advance, covering the period 12/27 through 2/24. When we received the money, we recorded cash, $3,000, and unearned consulting revenue, $3,000. So on our balance sheet now, cash increased, and we have a liability, the unearned consulting revenue, for $3,000. And that $3,000 we're going to earn day by day between 12/27 and 2/24. So the first thing that we have to figure out is how much revenue are we going to recognize in December? So we have the 27th, the 28th, the 29th, the 30th, and the 31st. So that's 5 days. So we have 5 days of service revenue. So if it's 60 days, 5 out of 60 days times $3,000 means we've earned $250 in 5 days. We've earned $250 in 5 days. So we want to reduce the unearned revenue by $250 and record revenue for $250. So when we do that on our balance sheet, we're going to see that now the liability unearned consulting revenue is $2,750. And on our income statement, we're going to have an additional $250 worth of revenue. So on December 31st, the journal entry is going to look like this. We have decreased our liability. Unearned consulting revenue is a liability. We've decreased a liability. When we decrease a liability, we debit it. We have increased revenue. When we increase revenue, we credit it. So we've debited unearned consulting revenue and credited consulting revenue. All right, the next one we're going to talk about is accrued expenses. So what accrued means is that we own it. It's kind of like if you think about accrued vacation at work, it means that you own it. If you quit, they have to pay it out because you've accrued it, you own it. So accrued expenses are expenses that we have incurred, but we have not yet recorded. So in this case, there's nothing that happened before. With the unearned revenue, there was something that happened before. With prepaid expenses, there was something that happened before. With accrued expenses, there's nothing that happened before. All we're doing is, it's the end of the period. We know that we've incurred an expense that we haven't yet recorded. So we're simply going to record it. So we're going to record the expense, and we're going to record the liability, which will be, like wages payable, taxes payable, accounts payable, some liability. So Wages is a really common example because, and it's tricky too, because it changes every month. So it's a common example because at the end of the month, even if you're paid on the very last day of the month, if you quit that day, does your employer owe you more money? They do. They do, because you had that like week or 2 week holdback before you got your first check. So even if they pay on the last day of the month, there's still money that they owe you. And that means that there's still an expense that they haven't recorded, that they will record when they record payroll again. So here we have Fast Forward pays its employees $70 per day, or $350 for a 5-day work week. They pay every 2 weeks on a Friday. So the end of December, 12/31 is a Wednesday. So the last time they got paid, and we're pretending like we have no holdback. The last time they got paid was the last Friday. So they worked Monday, Tuesday, and Wednesday, and that expense has not been recorded. Monday, Tuesday, and Wednesday, and that expense has not been recorded. So $70 a day times 3 days, there's $210 worth of salary expense that has not been recorded. So our adjusting entry is going to record salary expense and salaries payable. So we're going to increase the expense with a debit. When we increase an expense, we debit it. We're going to increase the liability for salaries because we're going to have to pay that in the next month. When we increase a liability, we credit it. So what we've done with this journal entry is, if you look on the income statement, we've increased salary expense $210. And if you look on the balance sheet, we've increased the liability, salaries payable, $210. So now what happens is we've recorded the expense, right? We recorded the expense because it happened in December, but we're going to pay the expense in January. So now you have to think, because we already recorded the expense. We recorded the expense when we incurred it in December. So now in January, when we pay the expense, we can't record expense again because we already did that. So when we pay it, what we're going to do is decrease cash and decrease the liability, the payable. We're going to decrease cash and decrease the liability. So for this payroll period, we have accrued expenses at the end of one period. So we know we have $210. We get paid on January 9th. We pay on January 9th. So there's 10 days, there's 2 weeks in the pay period. 3 days were in December. 7 days were in January. We recognized the expense for these 3 days in December and recorded this liability. So when we pay the payroll, we're going to reduce the liability for December, and then we're going to record the expense for January. These are the 7 days in January. So we're going to record the salary expense for 7 days in January. So our payroll is going to be $700. 210 of it reduces our payable. 490 of it records the expense. So now if you look on our financial statements, salaries payable will be gone. You'll see salary expense in January of $490 and cash decrease $700. Accrued revenues is the same concept as accrued expenses. We've earned the revenue, but we haven't recorded it yet. It belongs to us. We've earned the revenue, but we haven't recorded it because we haven't gotten paid, or we haven't gotten an invoice. We haven't invoiced the customer yet. Maybe the job is in process, but we've finished it. So we've earned the revenue, and we need to record it in the correct period. So here we have a customer that agreed to pay $2,700 on January 10th of the next year. So on December 12th, they agreed to pay $2,700 in January for future services over the next 30 days. So starting on December 12th, we begin to provide services. So we've provided services from December 12th through December 31st, and we have not recorded any revenue because we would typically end up recording it when they pay us on the 10th of January. But we have to make sure that we record in December revenue that is earned in December. So we have 20 days worth of revenue that was earned in December. So if we take our 2,700 times 20 out of 30 days, we earned in December $1,800 worth of revenue, and we have not recorded it. So we're going to record consulting revenue, and the other account is going to be accounts receivable. Just like if we had invoiced them, the other account is going to be accounts receivable because they're going to pay us in the future. So now on the balance sheet, accounts receivable is $1,800, and on the income statement, you'll see an additional $1,800 of consulting revenue for December. Now, in January, they're going to pay us the cash. So in January, they're going to pay us the cash. Now, the tricky thing here is, in January, we've earned 10 more days worth of revenue. This revenue, this $1,800 worth of revenue, was already recorded in December. So you can't record that in January. Instead, that's the receivable. So we're going to record the payment from the customer, $2,700. We're going to get rid of the receivable that we recorded last month when we recorded the revenue in December. And we're going to record consulting revenue for the 10 days in January. So now on our balance sheet, we're going to have increased cash and decreased accounts receivable. On our income statement, we'll see an additional $900 in revenue. One of the questions on the quiz is about what type of adjusting entry has something that happened before, and that's prepaid expenses and unearned revenue. Then accrued expenses and accrued revenue didn't have anything that happened before. Okay, the next video is going to go over the trial balance and the financial statements.